Welcome to this explainer. Today, we're diving straight into what is honestly a masterclass in economic resilience. We are going to deconstruct a fascinating business case study of crisis, explosive growth, and calculated risk management on the Alabama Gulf Coast.
Here is our roadmap for today. We'll start with the Hurricane Frederic catalyst, move into the state's massive tourism machine, break down the economic multiplier effect, explore the modern real estate shift, and finally, look at how they're managing future coastal risks. All right, let's jump in.
Section 1. The Hurricane Frederic Catalyst.
Picture this. Before 1979, the coast was mostly just modest, seasonal cottages. It was essentially a sleepy fishing village. But then, in September 1979, Hurricane Frederic made landfall as a massive Category 4 storm. It wiped the slate completely clean, destroying about 80% of all the buildings. But you know what? Rather than retreating, opportunistic developers looked at the wreckage and saw a blank canvas. That disaster was the direct catalyst for the massive concrete high-rise condominium boom we saw throughout the 80s and 90s. It's literally a night and day difference. What started out as a humble, remote fishing camp at the end of a two-lane road has been entirely overwritten into a towering billion-dollar resort destination. It is an economic machine literally built from the ashes. Moving on to Section 2, Alabama's tourism machine.
Get a load of this number. In 2024, travelers spent a record-breaking $23.9 billion in Alabama. $23.9 billion. That marks the fourth consecutive year of really solid growth. And that cash doesn't just sit in a vault somewhere. It is out there directly supporting nearly 250,000 jobs across the state.
To really wrap our heads around the scale of that growth, let's rewind a bit. Just a decade ago, in 2014, spending was at $11 billion. So it's more than doubled. And if you look all the way back to the state's tourism footprint in 2003, the modern 2024 figure represents a staggering 250% increase in tourism expenditures. That is just explosive growth.
And geographically, the breakdown tells a wild story. The Gulf Coast completely dominates, capturing over 40% of total tourism expenses. The central region comes in next at almost 22%, with the north region right behind at roughly 21%. Think about that. A tiny 32-mile stretch of beach is doing some seriously heavy lifting for the entire state.
And the momentum isn't slowing down. Across the southeastern U.S., the industry is rapidly approaching 90% of its pre-pandemic levels. The target right now is full tourism recovery by the year 2025, which is absolutely crucial because it signals incredible market confidence across the whole region.
Section 3. The economic multiplier effect. Now, for the business students tuning in today to analyze tourism job creation, you are going to love this part.
The structural math here is incredibly precise. Every $140,726 in tourism spending creates exactly one direct job in Alabama. But it gets better. The economic multiplier effect kicks in, meaning every two of those direct jobs cascade through the economy to support one entirely new indirect position elsewhere in the state.
So where are these jobs actually going? You'd probably guess hotels are the biggest employer, right? Actually, no. The data reveals that food service and eating establishments fuel a massive 53% of all these tourism jobs. Lodging is a distant second at 21%, followed by entertainment at 12% and retail at 7%.
Yeah, it turns out people really love to eat. Those local culinary hubs, the fresh Gulf seafood, the award-winning restaurants, they act as the massive, undisputed engine driving over half of this entire statewide employment formula.
Now, why does this matter to an average resident who maybe never even sets foot on the sand? Well, tourism generated $1.4 billion in state and local tax revenue in 2024. Those lodging taxes flow right into the general fund. That acts as a direct financial dividend, effectively saving every single Alabama household $707 a year to maintain current state services. So, everybody wins.
Which brings us to Section 4, the real estate shift. With such explosive economic growth and billions of dollars in play, we have to ask a critical question. Who exactly is investing in this coastal property today? Because the answer has shifted dramatically over the last few years. Since the pandemic, we are witnessing a fundamental transition. We're moving way past a seasonal tourist hub dominated by winter snowbirds. Today, the market is driven by remote workers relocating permanently. Full-time families are moving in, and that changes absolutely everything. A year-round residential community demands entirely new infrastructure, new schools, and completely different commercial zoning.
Because of this, the mindset of the investor has totally evolved. The outdated view is simply, I'll buy a beach house and the quick rental income will completely pay for itself. Not anymore. The modern reality is that investors view beachfront property as a vehicle for long-term wealth. The rental income is just a supplement, kind of like a stock dividend, but the real return comes from steady, long-term capital appreciation.
Finally, Section 5, Managing Future Coastal Risks.
Look, any sound business analysis has to look at the downside, right? We've mapped out a phenomenal economic boom, but we have to consider the structural and financial threats looming over these billions of dollars in coastal assets.
The environmental realities are pretty stark. You've got $8.2 billion in property sitting under 6 feet of elevation. Add in extreme wind and flood risks, and insurance markets have tightened aggressively. A lot of policies are shifting to actual cash value, meaning depreciation is deducted before a claim is paid, and they're slapping on massive 5% deductibles. It essentially leaves many owners functionally uninsured because a payout just wouldn't cover the cost to rebuild. Plus, lenders are strictly scrutinizing condo HOA financial reserves before approving any loans.
So what's the solution? It all comes down to building smarter. Extreme weather threats force the adoption of rigorous building standards. Today, the modern real estate market absolutely demands fortified property construction. Meeting this elevated standard isn't just a nice-to-have, it's absolutely necessary to secure investments, withstand the elements, and actually qualify for vital insurance premium discounts.
Let's wrap this up.
Ultimately, understanding the Alabama Gulf Coast requires viewing it as an immense macroeconomic balancing act. You have to weigh the billions generated and the hundreds of thousands of jobs created against the compounding environmental realities. So, it leaves us with one massive question as we look forward. As the climate shifts, will modern mitigation strategies, like fortified construction, truly be enough to protect this coastal wealth from the next black swan event?